All right, hello everybody. Welcome to this evening to Sustaining Impact Investment and Expert Fireside Chat with Professor Rosemary Addis and Karim Harji. I'm Ben Neville. I'm an Associate Professor in the Faculty of Business and Economics, and I'm also a Deputy Director of Melbourne Climate Futures. And it's my great pleasure to welcome you here and to moderate this evening's Fireside Chat. Before we begin, I would like to acknowledge the Wurundjeri people of the Kulin Nation, the traditional owners of the land on which tonight's event is taking place, and pay my respects to their elders past, present and emerging. I also acknowledge the traditional custodians of the land on which our online audience is currently meeting us from today, and whether that's in Melbourne, Victoria, Australia or anywhere else in the world. And I extend this acknowledgement to all Aboriginal and Torres Strait Islander and other First Nations people joining us tonight. And on this note, and in the context of tonight's topic about impact, I'd like to note that the plight of Indigenous people in Australia is an important and prominent impact issue. I'd like to acknowledge the support and leadership of the Faculty of Business and Economics and the University, particularly through the establishment of the Dylan Dewar Centre for Indigenous Business Leadership. And if you're not aware of the work that that centre does, I encourage you to visit their website. Just on the formalities of the evening, this evening's proceedings are being recorded and they'll be available on the Faculty of Business and Economics website. Following the fireside chat, there will be an opportunity for a Q&A session. For the online audience, the chat function has been disabled, but if you'd like to ask any questions, please submit them through the Q&A function and we'll collate the questions and then put them to the speakers. For our in-person audience, there will be a roving microphone, so if you have a question, of course, just please raise your hand and wait for the microphone to be brought to you. Now, tonight's fireside chat continues on from a highly engaging alumni breakfast event in July this year when Professor Rosemary Addis, Enterprise Professor in the Faculty of Business and Economics, provided a keynote speech on the need for an impact focus, which inspired considerable conversation. Rosemary spoke about the challenges that are confronting us on poverty, equity, displacement, and especially on the climate emergency, where we now have only 9 years of our carbon budget remaining before we break through the 1.5 degrees Celsius barrier, which will be a death sentence to many people around the world, to entire Pacific Islands, and to our Great Barrier Reef. Rosemary made the point that what got us here will not get us there. If we are to choose a more positive future, we need a change in mindset, in structures, in standards, in business models, and in what is really valuable. And much of this work is well underway. Rosemary provided examples of innovative financial solutions, funding programs supporting road safety, child immunisation and women in Southeast Asia. She also provided examples of major transformations in standard setting and accounting, such as the International Sustainability Standards Board and the UNDP's SDG Impact Initiative. At the university, there is currently a program to extend our understanding of our research impact led by Professor Jenny Lewis, which attempts to go beyond the typical indicators of citations in A-star publications to recognise our material influence over public discourse, public policy and business behaviour. The initiative that I'm partly involved with, Melbourne Climate Futures, was deliberately set up by the university to bring our resources and capabilities together to have a more focused and urgent impact upon the climate emergency. Similarly, the Australian Business Deans Council has issued a declaration on climate action, recognising the role of business and business education in responding to the climate emergency, committing to collaborate on improving curriculum, standards, research and other opportunities. The Faculty of Business and Economics is a member of the United Nations Principles for Responsible Management, and we won an award for our reporting on our sustainability activities earlier in the year. So we see the world is changing and business is changing and business schools are changing. As well as impact, I'm sure you've heard terms like corporate social responsibility, sustainable business, corporate purpose, shared value, ESG, environmental, social and governance issues, and perhaps stakeholder capitalism. So in tonight's fireside chat, we are attempting to continue the conversation begun by Rosemary and to take advantage of the visit by an expert in the field, Karim Harji from Oxford Said Business School, to go deeper into this impact revolution. In tonight's discussion, we'll attempt to get a little more of a practical understanding of what the field of impact has to offer our organisations to respond to the serious social and environmental challenges facing us. So it is an honour to now formally introduce you to our speakers this evening. So firstly, Professor Rosemary Addis, AM, and I'll invite Rosemary to join me on stage. So Professor Rosemary Addis is an internationally recognised leader, director and strategist in impact, sustainability and innovation. She uniquely combines commercial acumen, honed as one of the world's leading lawyers, with strategic insight and foresight, sharpened in senior roles across sectors and transformational leadership that has shaped breakthrough innovations, organisations and markets. Rosemary is founding managing partner of Mondial Impact, a unique global practitioner-led partnership of trusted advisors activating boards and decision makers to be ready for the future of business and investment in a changing world. She's Enterprise Professor of Impact, Sustainability and Innovation at the Faculty of Business and Economics at the University of Melbourne and collaborated with Oxford University and Harvard Kennedy School. She has a portfolio of chair and board roles, including Chair of the Board of Advisors of investment firm Swift Capital and Climate Ready Australia 2030. She's advised SDG Impact at the United Nations Development Programme, the OECD Social Impact Investing Initiative, the World Economic Forum Ideas to Practice and the World Banking Group. She's the Social Innovation Strategist for the Australian Government, G8 Social Impact Investment Task Force and founding chair Impact Investing Australia, which was the Market Builder of the Year in 2018 and 2020. Rosemary's been recognised as an inaugural Sorensen Global Impact Leader for lifetime contributions to impact, member of the Order of Australia, ranked among top thought leaders by Women in Finance and among Australia's 100 women of influence for contributions to innovation, and by Chambers Global among the world's leading lawyers. Her thought leadership is widely published, informing and influencing a generation of leaders. Our other speaker this evening, Karim Harji, and I welcome Karim up to the stage as well, is a practitioner, educator, researcher, board member and leader in shaping impact markets. Karim has worked with prominent private, public and social sector organisations on evaluating the impacts of grant making and impact investment strategies of individual programs, complex portfolios and ecosystem level initiatives in developed and emerging markets. He's pioneered executive education in impact measurement at the University of Oxford and delivered executive courses at universities across the globe. As a founding program director of the Oxford Impact Measurement at the Saïd Business School, he established a new executive program designed to critically examine impact measurement concepts, practices and issues at the intersection of the private, public and social sectors. Karim is a partner at Possibilian Ventures, which backs companies that increase wellbeing, prosperity and sustainability, and managing director at Avalisis, an impact measurement and management consultancy. He was previously a co-founder and director at Purpose Capital, now Rally Assets, where he established and led its impact investment advisory practice. He was the co-chair of the Impact Measurement Task Force convened by the Government of Ontario and a member of the Impact Measurement Working Group of the G8 Social Impact Investment Task Force. Karim was previously advisor to the Rockefeller Foundation on social impact measurement, and he co-founded the Topical Interest Group on social impact measurement at the American Evaluation Association. I think that's all we have time for tonight. They're quite clearly far too accomplished. Please, everybody, welcome them to the stage. So thank you both for joining us tonight. Let's start the conversation. And Rosemary, if I can ask you to set the scene a bit here. There are so many structural and other challenges people and organisations are facing now. Why impact and why now?
Thanks, Ben, and thanks everybody for being here to be part of the conversation in person and virtually. So when I started this work around 20 years ago, a big focus for me was how we could keep our strategic orientation towards the outcomes we wanted to achieve, and that unless we could shift resources and particularly capital differently, it was going to be very difficult to achieve even promising solutions at scale. When we look at the world now, the importance of those issues has become even clearer, and we're seeing government budgets around social service spending grow exponentially around the world. We're still seeing growing inequities, and that was even before COVID. We know that the big mega trends that are shaping our world, and as recently restated by CSIRO, are all around the social and environmental issues, as well as the great transformations we're seeing in how we work in digitisation and technology. The big issues in front of us for the next 20 years are adapting to climate change, looking at our energy systems and ensuring that they're leaner, cleaner and greener, addressing the health imperatives, including for an ageing population, and adapting to the digitisation and the next wave of technology, which could promise many solutions. We also need to ensure that it optimises for human potential and for human agency, and there's a big disparity in trust for us to address. Through the last couple of years, and particularly the impacts of COVID, we've slid backwards against the global measures of social progress, including the United Nations Sustainable Development Goals, for the first time in 30 years on basic measures around health and poverty alleviation and education even. You know, millions of kids who had gotten into school who've now no longer in school. And with the environmental imperative so prescient in front of us, we really are at a sliding doors moment collectively. The choices that we make in the next 10 years will determine the kind of future that we have for ourselves and for our kids. That's just a fact now. And we will choose the future that we have through the choices that we make. And that can't be any one sector's job, it can't be any one organisation's job. It's going to be the way that we can actually orient ourselves, just like they did in the US when they decided to put man on the moon, how we orient ourselves towards the goals that we need to achieve in order to ensure that we have a sustainable future. There's a lot of noise, there's a lot of disruption, there's the geopolitical issues to deal with, and as we do that, impact is a very helpful orienting framework and frame within which to keep clarity around what it is we're trying to achieve. And before we even get to all the technical detail, to really anchor ourselves around a world where we're trying to actively avoid creating more harm, to create more benefit for people on the planet, and to contribute solutions where they're needed most.
Yeah, wonderful, thank you. So Karim, if I can go to you now. So you've especially focused on defining and measuring impact. What is impact and how can we measure it?
Yeah, thanks, Ben. And again, I appreciate being invited and to speak here with all of you, both in person as well as virtually. Impact is such a loaded term in some ways. We use it quite colloquially, loosely, but it means some very specific things, particularly if you're in the business of trying to measure it. And I'll talk a bit about the social impact side of things, because that feels like quite timely. Impact generally refers to some of the long-term changes, either in people or planet, issue areas, the systems within which we work in. We're really trying to understand what is changing, how is it changing, for whom is it changing, and what type of changes were due to the kinds of interventions or investments or businesses that we're seeking to promote. So often we look at this in terms of what is not happening or what is not taking place, how do we address it? So either there's a deficit or an issue in a certain area, you'd want to have a positive impact and something that's additional and additive. As Rosemary was alluding to, sometimes we want to have less bad, so less of the negative. And the balancing act around how we measure the less bad and more of the good is partly, not only challenging, but we can't have just one without the other. Because in some cases, we want to slow down the rate of destruction and negative effects. On the other hand, we certainly want more of the good stuff. And partly when we talk about impact, there are also multiple levels. Sometimes impacts are positive and quite visible and tangible. We can count them, we can observe them. We know that things are changing in the short term. The more harder things are what happens that's invisible, intangible, and perhaps over the long term. It's not always easy to identify what is changing and in what ways, and it's not always easy to predict what those changes might look like. But that interplay between the different time horizons, the different types of change, I think is what we're trying to get to when we talk about what impact is and what measurement looks like. But generally, we're talking about positive changes, even though we recognize that change can take various forms.
Can you provide for us an example of where this impact approach has actually led to some sort of change?
Yeah, so there are a number of, let's take an example that people might be familiar with around just providing good jobs or quality work. typically when we think about what it means to create a good job, there are some objective measures where you might count the number and types of jobs, the type of level of job, whether there's a living wage or some kind of benefit. But what if we ask people what constitutes a good job? You might get a range of different responses around what good or quality looks like. On the other hand, it's very hard to kind of add up all of those, let's call them subjective assessments of what a job is. But it's not enough to simply count how many jobs were created, what positions they are, and the split of gender. That only tells you part of the picture. But that seems to be sometimes what we do when we default to reporting on job creation. We count at the top line what is happening rather than why it matters and for whom. And so part of what impact measurement is trying to do is provide a bit more of a balanced and accurate approach around who defines what is good or quality, how does that vary across different groups, and when we talk about job creation, who benefits more than other groups. So some groups tend to benefit for certain kinds of jobs or certain kinds of work, and other groups tend to lose out. Do we have a conversation to make sure that the job benefits for some groups are visible and the ones that are not counted or invisible are also elevated using the language of impact measurement? And so in that case, I think what we're trying to get is a more holistic and accurate understanding of what a good job really looks like. For some people, it might be you can pay your bills on time. For others, it might be you have long-term goals and aspirations for your kids, or maybe there's a multi-generational legacy there. In some cases, you want to respond more easily, let's say, to address any kind of shock, such as COVID. In other cases, you have a long-term kind of planning or set of goals that you want to be able to feel economically and also socially secure about. So in this case, even if we count whether someone has a good job as defined by having employment, a living wage, et cetera, there are a number of other components that we might want to unpack around what that looks like.
Good, thank you. Rosemary, people may have heard the term impact in relation to investment. So can I ask you, where does impact investment sit and what's the state of play there?
So impact investment was coined as a term around 2009 as part of the work that the Rockefeller Foundation led in field building to see how we could encourage more investment that intentionally was designed or intended to generate positive impact, more conscious about the impact it was creating, and where that impact was measured. The term has come to represent a field of practice around investment that has that intentional design for positive social and or environmental impact as well as financial return, and that the the impact is being measured. So the examples now in the market range from large-scale infrastructure investment in things like affordable housing or clean energy through to the sustainability-linked debt and bonds, including sovereign bonds that we've seen issued by the likes of Mexico, Bolivia and Indonesia during COVID, and by the IFC, looking at things like health supply chains over the last couple of years, through to private equity investment in enterprises that might take a thematic lens or might take a geographic lens, and also innovative products, including things like social impact bonds, which were first pioneered in the context of government service delivery with an outcomes orientation, and for the first time bringing private market investors into supporting some of that service delivery. So we see a spectrum of activity that's agnostic as to asset class. It's really about the design principles and the measurement. Increasingly, we're seeing some of these factors now come into more and more of mainstream investing, including more calls for reporting and accountability around the impacts that are being achieved, and I'm sure we'll come to that.
Yeah, good. So, Karim, if I can ask you then, if we're talking about impact in relation to investment, we're trying to shift capital. You spoke before about balance and accuracy, and you spoke very much to the nuance and the context and the subjectivity around how we might understand and measure impact. Can you talk to how that needs to then be balanced with the needs of the investment community? And so what is the state of the art in measuring impact?
Yeah, we've come a long way, just even in the last 5 to 10 years. I think on one level, there are a lot of starting points. So if you want to define the kinds of goals that you have around impact, there's terminology, there's practices, there are tools to be able to do that. If you're looking for a set of indicators or KPIs, there are lists and repositories of that. If you're looking to benchmark yourself in certain sectors on your impact processes or your performance, there are starting points for that. Even 5 years ago, there were big and notable gaps on each of these areas. Now we are beginning to get into this phase around looking at standards and frameworks that in some cases are quite universal and global, in other cases that are quite thematic and sectoral. And there's a bit of a balancing act, because often the complex social issues we're trying to deal with can't be just neatly spliced into some of these sectors, even though those are helpful starting points. On the other hand, for investment decisions, sometimes there's a pressure to try and simplify. And so partly what I think impact measurement in this domain is trying to do is try and get the best of both worlds. To create some, for example, top-line, simplified ways of talking about goals and metrics, but also acknowledge that the nuance of asking people, what does change look like in your context, and using technology to be able to do that, and combine the two to give a much more holistic picture of what impact means in practice. That's, I think, the opportunity. So on one hand, you're seeing a lot of development of principles, guidance, frameworks around how to build approaches to measuring impact, particularly for corporates and institutional investors. On the other hand, we can't leave out the perspectives of the people that are most affected by change, whether it's investments or kind of projects, et cetera. How do we get those voices and perspectives around whether changes are positive, negative, neutral, short-term, long-term? We now have technologies that are able to use mobile phones and other related technologies to be able to bring those voices up in ways that we just couldn't do before. Before we had to sample a specific proportion of people and hope that that's representative. And now what's exciting is we can actually hear from literally everyone who's affected. But it is a bit of a balancing act, and we're probably in a messy middle phase of industry development, where on one hand, we're not trying to make this too difficult so that we don't not do it. On the other hand, if it's too easy, then we open ourselves up to claims of greenwashing. You can make claims around impact that actually aren't accurate. And so we're in this phase right now where there's a lot of opportunity. We're beginning to see some emerging risks, but actually there's a lot of movement and work that's happening across all those levels.
Good. I'll continue with you. You mentioned that there are lots of different guidelines and toolkits for people. And many of the people in the room here and at home or wherever they are watching online will be in leading positions within organisations. So what advice can you give to them about where they can start on this journey?
Yeah, I think the first thing is to just be clear on your goals and what your intentions are. That's almost step one of impact investing is have intent. There are frameworks like theory of change or the impact management project's 5 dimensions, which Rosemary alluded to. They allow you to articulate and use the language of impact in articulating your goals. Then you can think about how you might integrate those considerations into all parts of your investment activities. And there's a lot of guidance and principles, including the operating principles for impact management, that provide you with a framework around how to be quite deliberate and structured, for example, at each stage of the investment life cycle. And now we're in this phase around looking at integrity of data. How do we know that when data and claims are produced, that they actually stand up to scrutiny? And how do verification and assurance regimes, the ones that we perhaps are more familiar with, transpose over into this new area? That's where there's a lot more work to do. So I think on the first component around defining our goals, there's a lot of tools. On looking at how we integrate them, there's a lot of guidance. And then this next phase of do all the results and performance data stand up to scrutiny? That's where we're about to find out whether they stack up. And there's going to be a combination of data, platforms, and regulation that are going to be required to get it right.
Yeah, great, thank you. So Rosemary, I'm wondering, how is this playing out differently in different segments, such as corporate versus investment, public versus private markets?
So that's been a bit of a different story around the world. I think the unifying theme is that impact and sustainability are on the agenda. Wherever you are now operating in markets, then it's much more in focus, and there will be increasing focus on what is being achieved, including on the economic and social costs of how businesses are run. We're seeing investors increasingly looking at the risk picture, but it's messy in terms of the change that we're encountering. So we're seeing the biggest shake-up we've seen in accounting rules and reporting principles probably since World War II, including, as you mentioned in the opening, the International Sustainability Standards Board and the work that they're leading. That will be part of the picture, but it won't be a whole answer. We're also seeing the shake-up that you have whenever you have major waves of change coming through, and that there's a politically potent cocktail, and we're seeing that particularly in the US, where there is a lot of pushback in some parts, and a lot of it's quite politically driven, and that is affecting the investment community, but it's also costing taxpayers and it's costing states. Those states imposing constraints on sustainable and ESG investing, incurring a much higher cost of capital. So we're starting to see the impacts in the investment markets now, where the prices are starting to respond in terms of how sustainable a proposition is. That's not uniform yet, but it's certainly starting to come through, including in sustainability-linked debt, and there are some experiments that are moving from climate through to other factors, such as, if you look at Novartis, for example, has issued bonds into the market that actually give them a cheaper cost of capital if they are providing greater access to pharmaceuticals in lower and middle income countries. We're certainly seeing that some markets like the US have been more led by private markets activity, and with some involvement of the philanthropic sector in catalysing that. Other markets like the UK market and parts of Europe have been more government-led, both with carrots and sticks. So it's playing out slightly differently, but the unifying themes are becoming much clearer. In particular, that impact is on the agenda, that it's going to start affecting both corporate strategies and investment, because if we think about it, these are different facets of the same picture. Where does the investment capital go? It goes into companies, small and large. And of course, we're seeing from the corporate sector that some of the strategic focus has come through corporate responsibility. It's come through greater awareness and evidence base, including the work that Rob Kaplan and George Seraphim led out of Harvard, that says that sometimes these programs don't achieve their aspirations because we're not actually thinking big enough. We're thinking too much from the centre of one organisation and not reimagining the ecosystem. We're seeing that come through now in some of the shared value work, as well as Peter and other colleagues will have seen in the market, where we're also seeing that work lead into an understanding that where you can have more proactive strategies, you can create more value and more opportunity sets. And so you're seeing Mark Kramer and colleagues write on things like why ESG fails and how social innovation can be a key to unlocking new value. So we're seeing a lot of strands that are weaving a rich tapestry of developments, but the kind of underlying core threads of that are becoming clearer. And what we'll see in the next 3 to 5 years will be much greater calls and requirements of transparency, and we will also see more reporting on the economic and financial costs of poor performance on social and environmental metrics. Those who haven't seen the work coming out of the Impact Weighted Accounts Initiative from Harvard, it's very interesting to look at the data sets, 3,000 companies where they're actually publishing the accounts of companies weighted for their performance on key metrics, including environmental performance, and whether you agree with the methodologies or not, consistently applied across the same industry, you can see leaders and laggards. We're also seeing some consistent pictures emerge through the work of groups like the World Benchmarking Alliance, where you can see, for example, in their financial system benchmark published just a couple of weeks ago, that there is night and day between leaders and laggards, and the leaders are the organisations that have clarity of purpose and transparency, not because they've got the full story settled, but they're more transparent and able to be clear about what their goals are, what they're measuring, what they do know, what they don't.
So you've mentioned leaders. So can you provide any examples of who is doing well in this, perhaps corporations, but perhaps also projects?
Yeah, for sure. Do you want to start, or would you like me to?
You can go ahead and I'll jump in with a couple more.
For sure. So I heard someone describe it recently. It's kind of like the ice skating, you know, when everyone's coming around the bend in the, and so, you know, it could be anybody's race. And I would say at the moment we have lots of bright spots of organisations that are doing good and interesting things, but there are very few organisations that have the whole picture correct. So we've seen Danone, for example, do some very interesting things, including their collaborations with Grameen, where they have set up parts of their business actually focused on solving the problems at hand. So one example is a high nutrient fortified yogurt product that they produced for communities in Bangladesh. There's now enough evidence to show this is improving the physical and cognitive health of kids. It's produced at something like 6 euro cents a unit. It's creating jobs up and down the supply chain in local economies, and they sell something like 100,000 units a day. There are examples where starting on this kind of activity is driving continuous improvement within organisations. So that led Danone down a path of more of these business opportunities, for example, including then setting up funds, some of them with Mars Corporation, to enhance performance of smallhold farmers up and down the value chain. We're seeing a number of the large private equity firms create beachheads around impact, which they're then having as an offering of a spectrum through their ESG funds, which are looking more at negative screens, through to looking to more enhanced offerings, including some impact offerings, or trying to build the lessons. So EQT, for example, has EQT Futures, which they have launched recently, including a high-profile mission board that's advising them around that. A number of the big firms have taken these steps. We're seeing banks like BNP Paribas issue sustainability-linked debt and really start to build then their own systems to be sharing information, including around science-based targets, with their clients and offering cheaper cost of capital for those clients and customers that are performing well across sustainability metrics.
Yeah, so maybe I'll add a couple more to that across the investment spectrum. Acumen is a name that is familiar to many people. They also spun out a group called 60 Decibels, which does a lot of this customer feedback work and really trying to understand from customers of products and services of social enterprises, how well they're being served, are their lives improving, and what does change look like? So they've been, I think, a really good example of how you take quite flexible philanthropic capital as well as other kinds of investment capital and go and reach some of the hardest to serve and use those as demonstration effects for others. And then as we work our way up the spectrum, for example, around venture capital, a group called Bethnal Green Ventures in the UK, in the whole tech for good space, has done some really, I think, remarkable things around how they report on an annual basis. A couple of highlights include around what they do on diversity and inclusion across both their own team as well as their portfolio. And this concept of impact risk, you know, what are the risks that impact in the way that they hope to see don't actually realize or materialize? So being quite transparent about what their goals are, but also what could go wrong. And this notion of impact risk is something that's an emerging topic that I think they model quite well. And then as we go further up market, Bridges Ventures, which again is somewhat familiar to some people, in private equity, and now they've got a variety of different funds. They were one of the groups that were behind the impact management project and really led that and consolidated some of the language and learning around the dimensions of impact that we spoke briefly about. And then another example is Calvert Capital, looking more on the debt side. And they've been quite thoughtful about applying a portfolio perspective. And one of the questions we have in this space is, how do you add different kinds of impacts up? And how do you do that in a way that tells a story, particularly if you're an intermediary of capital? You're not directly, for example, making loans, or you are the channel through which you access mainstream capital. They've done some really good thinking about how to look at direct versus indirect impacts. So those, I think, are some good examples that are not only preaching and practicing what they preach, but are actually setting the bar high for the next generation of ventures, companies, and investors that are going to follow them.
Good, thank you very much. So I'll ask one more question and then we can go to questions from the audience, including the people at home online. And so we've got Tess here who is taking those questions. We've got a few, have we? Yes, good. So please welcome more questions. So if we can flip to the other side of the coin to think about, what are the obstacles? This is not easy. It's a sort of a new field that we're moving into. So where do people get stuck and how can they become unstuck? So that's to either of you.
Yeah, so maybe I'll start. I'll say that one point is that we're trying to compress a lot of activity in a relatively short timeline. Accounting standards took, depending on where you start counting from, anywhere from at least half a century to about a century to get to where we are now. We're probably in the first couple of phases of that comparable journey around impact performance, and data. We are, in some cases, adapting the tools from finance and accounting to social and environmental domains, some of which is working well, and some of it which is not, or probably not suited. And so as we get into the first couple of decades of this journey, and we know that the pressures that Rosemary outlined in her opening remarks are even more urgent, it's forcing us to do what we normally would do over multiple decades in a much shorter time frame. There's obviously an opportunity, but there's a challenge associated with that. And I think the balancing act is how do you make it easy enough for organizations and investors to do more of this and do it well, and not too hard that it feels complex and challenging. And I think we're in this middle piece right now where some of the work feels actually quite accessible to many organizations, and some of it feels incredibly complex when you're trying to model and project impact over the long term. But I do think we need to raise the bar higher progressively. So I think that would be one question. I think on where to start and also what's getting in the way, I think a lot of organizations are reinventing the wheel. And there's been a lot of good work done over the last 10 years to have starting points regardless of where you sit. If you're just new at this, if you're a business or an investor or a corporate, there's lots of good advice. No need to reinvent the wheel. The other thing is that sometimes organizations wait to get it perfect, but you can just evolve and adjust and get better as you go. It's very rare that we can get the perfect system anyway. And so start where you are and then build over time. And then I think the final maybe piece of advice is there's actually no reason not to do this. There's a lot of evidence that suggests that the business case is there, your customers or your stakeholders or perhaps your regulators are going to increasingly demand it, and the costs of not doing it are going to get increasingly higher. So you might as well jump out into the deep end and start, and as I said, there's a lot of good starting points. I think the costs of waiting, and some organizations are still waiting to figure out how they, when they should get into this fully. There's not too many of them. They're already beginning to lose talent. They're losing their competitive positioning. And we're seeing this quite practically play out around investment. They're losing opportunities to tap into investment pots. We're certainly in a very challenging interest rate and macro environment right now. But on the investment side, we're seeing those that have strong and clear positions on impact and methodologies seem to be benefiting and weathering the storm a bit better. It might be early days, but I think that there's a competitive angle here to also hold on to.
So I'll pick up on Karim's point about the perfect being the enemy of the good, and we do see a quest for precision, sometimes at the expense of being directionally correct. And precision isn't necessarily going to help us move forward. We need to get increasingly better and more sophisticated at our measurement, understanding what data we have, what's the veracity of that data, is it meaningful and helping us move forward. But if we wait to be precise, we might find out that we're precisely wrong and we're better off to actually be heading in the right direction. That's certainly one area that holds people up. A variation on that theme is that because there's been different ways that social and environmental issues have come into decision-making in the corporate and investment process, and it's been around selective positives sometimes or alignment, this sense of integration. Sometimes people start with a feeling of overwhelm about, these issues are large, what's our contribution? I know how we can kind of calculate what our revenue base is and what our profit line is, but when I look at our contribution to the social and environmental, that's much harder. And so helping to create that sense of understanding a context first of all, and it's going to be increasingly hard to make good decisions about materiality and about what you do need to disclose, and even compliance issues if organisations don't understand their sustainability context. And it's amazing what happens when people just put impact on the agenda, that it sparks a different kind of conversation, and we see that illuminate information about decision making that can be hugely helpful. I'm yet to see an organisation that does that authentically and with serious commitment, that doesn't start to see that they're leaving money and opportunities on the table, or perhaps risks that they're not yet sufficiently managing, and not identify areas of opportunity where they can move forward. Another thing we see is conflation of ESG and impact. And while ESG was originally designed to be broad and allow for a broad church of activity, the frameworks that have developed do have an emphasis on negative screening, some of them including some of the benchmark indices we're seeing go through a real disruption at the moment, because they have really measured the effect of social and environmental impacts on the bottom line, not the effects of corporates and activity in investment activity on the broader issues. And so what we're seeing as things like the European Union regulations come online is that Morningstar has tipped 1,200 funds off the ESG indices, saying they don't actually measure up to what the regulators are now calling for. And we also see this fear of headlines, or the fear of being among those funds that or organisations that are going to be challenged, creating a bit of paralysis. And I think the way to get unstuck from that is around this transparency. It's not about having it all right, it's about being very clear about what you do and don't know, and about the basis on which you are looking at your impacts or sustainability measures or scenarios in relation to climate, and being clear about what you do and don't know, what you can be certain about, and what needs more work.
Yeah, wonderful. So now we'll move to questions from the audience. We'll start with the people online first, and then we'll alternate with people in the audience. And perhaps we'll just have one of you answer each question so that we can hopefully get through a few more. So Tess, do we have a question from online?
We do. Okay. So the first one, it's not addressed to either one of you. What would incentivise or disincentivize sustainable investment? Would positive rewards work, or would punishments work?
It's going to be a mix of carrots and sticks. There's no question about that. There will be regulation. It's already started. And there will also be carrots in terms of opportunities, the ability to differentiate. I think what we're seeing at the moment in some carrots around cheaper cost of capital will probably translate into it will get increasingly expensive to be a laggard.
Thank you. Do we have a question from the room? One at the back there, please.
Ross Barker's my name. I'm involved with a philanthropic organisation, and they're looking at this issue of impact investment. And the interesting dilemma is, because we're told by the legal people we've got to make a prudent investment, which means it's got to have financial returns. So if we're going to go in an impact investment, we've got to give up some. This is the way it's portrayed, which I think is the challenge. It's like you've got to give up some of your financial return to get these other impacts, but because the other impacts haven't got measurable characteristics like financial return, it's sort of downgraded. So it's quite a challenge to actually get this past some of the legal people. We want to go down this path because we think it's important. But I'd be interested in your sort of comments on that. And the other question I was going to pose is, a lot of these investments take a lot of time to analyse, and there's a real role for intermediaries in putting together portfolios so you can diversify the impact risks, rather than having the board, as it were, having to go through each one individually. Anyway, there are two interesting aspects of this. I'd be interested in your comments.
What wonderful questions, Ross. He's not a plant, I promise.
And I'll let Karim answer, only to say that the first one is a real shibboleth that's been out there for a while. There is no necessary trade-off between impact return and financial return. In fact, what we find is that sometimes what the focus on impact is illuminating is that the risks have been mispriced, and the first movers often are the ones who actually are able to crystallise that delta. But
there are some great questions, so maybe I'll try and respond on a couple of points, and we can pick those up. So a previous business I founded, we essentially did just that in the Canadian market, helping philanthropic investors think about how they move more of their money into impact. And our provocation there was, there's really no other form of organization that uses a tiny proportion of its assets for 100% of its mission. And the legal frameworks that have been constructed are really outdated, but also some of the advice that's out there just isn't necessarily accurate or true. And so we'd worked with a range of foundations to progressively shift all of their capital, starting from 5 or 10%, and move that in line with their values or their mission. It does take time. It does require you to be quite thoughtful. But the perception that these investments are necessarily risky, maybe 15 or 20 years ago, was true. I think certainly now in a more vibrant market around impact investment is less true or perhaps untrue. You can get impact investments across the range of different asset classes. They're comparable to what you might already own. And in fact, I think, again, the other provocation we would ask, and we did this with a few of the groups we worked with, is what if you tried to unpack the negative effects of your existing portfolio and try to look at that? When we did this with a few foundations that we worked with, it was quite surprising, even with those that were somewhat thoughtful about negative screening, that their portfolios didn't really align with what they believed in. And I think this is true for many organizations. They haven't really dug below the surface to say, well, would we be comfortable investing in things if we knew what they actually were financing? And whether that's around destroying the environment, around making people's quality of life worse, around essentially promoting products and services that are detrimental to people's long-term futures. There are philanthropic organizations that unknowingly, because of intermediaries, are invested in those ways. So I think step one is figure out what you own and the negative and positive effect it's having. Think about how quickly you want to move, and I think how courageous you want to be. But I don't think the trade-off question is actually the thing that should stop organizations from moving fast. And the question around measurement, unsurprisingly, I do this for a living, so I don't think it's particularly hard to measure. I think organizations, if that's their mission, then they should be holding themselves accountable to it. And we now have the language, tools, and frameworks to do that much more easily. And I would say that to the question around intermediaries, there is a vibrant set of intermediaries. I'm not sure about the Australian market, but I know certainly globally that have come up in response to the very questions. And I think it's also quite an entrepreneurial opportunity for many organizations to develop the platforms and tools to do this. So we're beginning to see many of those shifts take place in quite positive ways. Rosemary, anything that you would add to that?
Oh, I agree with what you've said. I think it's always interesting, isn't it, that we focus on the work of analysing impact risk in relation to the investments where we're trying to have a positive impact, but not in relation to the rest. And actually, impact risk is a very interesting lens to look much more broadly. And just to also endorse that intermediation is key. A lot of the conversation gets hung up on supply and demand. A vibrant intermediary market is absolutely essential, including fund managers who can aggregate, design, originate product, and we need to be doing a lot more. It's a conversation for offline, the things we've tried to do in this market to build that intermediary market, and there's a lot more that would be helpful.
Good, thank you. I might mention that the university itself has a sustainable investment framework, and we struggle to get transparency about where we were investing our money in, and so it's meant that we've actually just recently changed to a new sustainable fund manager. So now a question from online again, Tess.
This one's a long one. It's 3 parts. Rosemary mentioned the different pathways to the development of the impact investing market in the US versus the UK and also some parts of Europe, private, philanthropic versus government-led. Which path do you think Australia is following? Next part. Also, with regard to the impact measurement and management function, is this being driven or stimulated in different ways in the US versus the UK? Bringing this back to Australia, what are going to be the key drivers in the Australian market? I can repeat the questions.
That's okay. I might take parts 1 and 3 and then let Karim answer part 2. Australia's has been a mix. There have been some elements that have been government-led going back kind of 10 or 12 years. And we were able to seed fund, for example, the first intermediaries financing social enterprise, using government money to cornerstone that. Without being political, we've had 10 years where it's been hard to get government at the table in a constructive way to drive the market development. And so we've led a lot of that market development from outside of government and done it as an independent public good, engaging with the different sectors. That has had benefits, but it's also been slower in some respects. Some key parts of infrastructure that would hugely benefit the Australian market, we haven't yet succeeded in getting into fruition. So the thing that, to my way of thinking, would be a game changer in the Australian market would be a wholesale institution. We started designing that and released the blueprint in 2015. There's a lot of steps that have been taken to get that implementation ready. It was referred to a task force that was led by Michael Trail prior to the election before this one. That task force reported supporting that a wholesale institution would be a game changer. That report was never released. And now the task force has been asked to refresh its recommendations. And we are hopeful that we might now be at a point where the confluence of circumstances means that we'll see some of these pieces of infrastructure, again, a possibility for the Australian market at a time where the government has also referred some of the regulatory elements that have frankly inhibited progress. Your Future, Your Super has been very problematic in moving the institutional, and in fact, the surveys that have done have shown that the institutions all felt inhibited from longer-term decision-making, anything to do with more positive aspects of ESG or impact as a result. That's been referred back to Treasury and Finance for reconsideration, and we understand we will see the Treasurer make announcements possibly before the end of this year, which is now only a few more weeks, about Australia stepping into the regulatory landscape around reporting. So there's never going to be one thing that's a silver bullet for market development, but if we could see a few of these things come into play with the carrots and sticks, we could see Australia take a giant leap forward. And we are also importantly positioned on the edge of Asia and the Pacific, and there is so much that we can do as a leader in this region. And that's another area that, if people are interested, happy to talk about what we could do. A bright spot in the last few years has been what DFAT has experimented with, the Emerging Markets Impact Investment Fund. That's been relatively small, but it's really shown what the potential is for the government to be catalytic and how that can unlock private investment alongside.
Mm-hmm. And I would just say quickly on some of the drivers in these different geographies, I would also distinguish between the US, UK, and parts of Europe, as well as emerging markets. Particularly in the North American context, you're seeing quite a heavy influence around the venture way of thinking about investment, and particularly in private markets, feed over into impact. That can sometimes be helpful, and sometimes it's not appropriate. So I think that was a strong influence, at least over the last decade. In the UK, the government was quite prominent around funding a lot of research and development of tools and practices, not only on the investment side, but also on the social enterprise and venture side, as well as charities and nonprofits. So there you felt, I think, a bit more of a balancing act between the two sides of that market, those that were providing capital and those that were receiving and working with capital. I think in a North American context, sometimes it feels quite investor-led and investor-centric. And then I think in the EU, more recently as well, quite a lot of guidance, much more holistic, and driven by regulatory pressures and concerns, but also quite consistent with, I think, how parts of the EU do that work. And again, there was much more of a balance between the two sides of the market, those that were receiving capital as there's those that were providing it. And this is now playing out quite differently across the world as well as in emerging markets, because emerging markets are trying to take some of those pieces, but problematically, if you're getting investment, for example, from European and North American investors, you're doing maybe a little bit of everything, so it's not particularly helpful. I think some of the next phase of this work might be a bit of a compromise between, let's call it KPI, investor-centric view of measurement versus a more business and venture an organizational-centric view of how does measurement actually help you make better decisions, and finding a bit of a middle ground. But maybe Australia and places like Canada, where I also do a lot of work, have that kind of sweet spot where we can see the best of both worlds and try and provide some good examples that might find those compromises.
And I just add to that too, we can't have too many places at the moment, like universities and others, that have the convening power, the cross-disciplinary expertise, actually create spaces for bringing together multidisciplinary approaches for incubating and designing the new products that are needed, and for really showcasing some of the solutions that could be commercialised in order to deliver the the progress that we need in key areas.
If I can just piggyback on that, what we're trying to actually build is take the best of these different fields, accounting, finance, evaluation, data science, really try and meld together something that works across disciplines. And so almost by necessity, we need places like this that allow for that kind of broad array of institutional expertise, the ability to apply in different contexts, but also the safe spaces to do this and research, test, and figure out what is working, but also ask the hard questions around what's not working.
And to host wonderful fireside chats, yes. So he invited you to ask a tough question. We've got one over here, do we?
Thank you. And Rosemary, it's wonderful to see you here at the university, and I've always admired your work, and I'm so glad that we've captured your capability here at our university. My question is a little bit slightly different to what Ross has said, that I'm on the investment committee for the Myer Fund and the Sydney Myer Fund, and over the last 2 years we've moved all of our investments into what we call a shared value investment program, which is, let's call it a sustaining investment program. And then over at AIA, and AIA Australia, we're the second largest life insurance company, but AIA Hong Kong is the largest life insurance company, listed life insurance company in the world. And we've been moving all of our, both bonds and our equities, into sustainable investing. Now, all that sounded like a great idea until the energy market went absolutely crazy versus benchmark. And so while we've had a very good intention, we've got people around us who are saying, well, hang on a second, all your funds are underperforming by 25% compared to benchmark because we took out everything to do with fossil fuels. How do you encourage us to keep going in the face of such a financial challenge?
Yeah, it's a great question, and it is very, a very pertinent question for where a lot of institutions are at the moment. And there's no perfect answer other than I think we'll see that change as governments start to step into energy markets. I think there's also some interesting opportunities coming through in significant transition funds. Brookfields is one, and what plays out with, with AGL. We will need some of that capability around the logistics, the infrastructure development, etc. So I think we'll see more opportunities in that transition space come online, I can imagine some of the conversations, but I think having gone that direction, I'd encourage you to stay the course.
You might feel more comfortable not profiting from war, I would think. Karim, did you have?
Yeah, I mean, maybe an alternative kind of way to think about this is also the time horizon piece, in that really if we were to look at some of the macro trends that Rosemary was talking about, the volatility that will probably go the other way at some point, and some of the returns, particularly around ESG and impact funds, are proving or have shown to be a bit more resilient over time. But I think that the current moment we find ourselves in is one of a lot of things that we probably couldn't have anticipated, or a lot of volatility in the way that has played out. Whether it's just a short-term kind of blip, it's something that I think remains to be seen. I think some of the medium to longer-term strategies around where's the world moving, what are the kind of focus around new technologies, regulation, et cetera, I think is still trending generally in that direction. It probably doesn't give you the kind of comfort you need when you look at the comparable performance. But I think the time perspective and time horizon perspective also is becoming more of a facet of at least some kinds of capital. And we're seeing some of those shifts not occur as, as negatively as we might expect, where there's reallocations to those types of portfolios, because as you were saying, they're profiting off of harm. And I think if we look at pension funds, at least some of the people that are paying into pension funds are much more aware and thoughtful about what they want their money to do or not do. And so there is a risk element that is coming on stream, at least for some kinds of institutional capital, that I think might bite some of those larger players that have made some of these moves to profit in the short term. But we'll see.
It also gets to the point that Rosemary makes about which future we want to choose, and that distinction between being led by an ESG lens, which might still be quite instrumental, versus the intentionality that we have with impact investing.
Well, there's that aspect, and there's also the distinction between trends and cycles, right? The long-term trend is still going to be towards those more sustainable options. The cycles that we're seeing at the moment will wash through. The question is how long they'll take to wash through.
Yeah, and the question of values alignment and increasing transparency, those questions are going to be even more difficult to address if you act in certain ways now. And we're beginning to see some institutional capital, particularly pensions, coming under fire for making some of those shifts, or at least not getting out as quickly.
We'll take that one. That'll be our last one.
Tony Burgess. Look, a question on the elephant in the world, in the room. As we know, whenever a new industry is created, and one that's particularly associated, what some people might associate with sentiment and virtue signalling, I'm not agreeing with that, but inevitably what human behaviour results, and hence we have the issue of greenwashing. So I'd just like to actually, perhaps Karim, if you could actually address that issue, because it is rampant, and I think the EU has made some recent moves to sort of crack down on it, and basically it's those claiming various social impact benefits, particularly perhaps on climate, on decarbonisation, that don't actually exist, and getting the benefits of sort of a lower cost of capital and the like, and that people are prepared to attribute it to that. Thank you.
Yeah, it is a problem for sure. I think we are beginning to see some of the pushback against it. So maybe a couple of different things. As you said, the regulators are now in multiple jurisdictions not only aware of it, but have actually gone across multiple high-profile examples and have found those and named the offenders, as it were, which is a signal that this is going to matter more. And increasingly, the fines are going to get higher, not only in the EU, but even more recently with the SEC. We're also beginning to see that customers, particularly on the retail side, but also more broadly, are much more skeptical and are seeking more robust evidence around these claims of impact. In parallel, there are reporting and regulatory regimes that are now coming on stream in much more serious ways. And actually, all the timelines, in some cases, while they were pushed out, are now being pushed forward in some jurisdictions. So the pressure around raising the bar on backing up these claims is actually going to come much more quickly than groups anticipate. If you talk to any of the large consulting firms, they all seemingly have thriving practices around advisory and assurance. We won't get into that debate. But also on the verification and assurance side of things, they're rapidly trying to skill up, staff up, and try and ensure that they are meeting a high level of quality and transparency. And at least from where I sit and the students that come through my program, I haven't heard really good examples of that. So I think one of the roles of universities in our program is one of the examples, but I think maybe there are examples here too. How do we raise the bar around not only in the assurance and kind of verification business, but across the board to be able to interrogate those claims, whether you're doing due diligence, thinking about how to allocate capital, thinking about how to verify different types of impacts. How do we build a new set of capabilities and expertise in this area? And how do we do it quickly? And I think executive education is a big part of that. But certainly at all levels of the university, we need to really amp that up. And the demand, I think, is quite astounding. I mean, we know from our graduates and people that come through programs, they're getting into senior positions really quickly. They're switching firms, and they're getting actually quite lucrative offers all over the place. So if I were to place a bet on, where should people spend their time on, or transition to, I think this is an area. The large consulting firms seemingly are hiring hundreds of thousands of people over the next few years. And I don't think the existing skill set from classic finance, accounting, et cetera, can always port over without being critical around asking some of these questions around impact washing. So for me, both there's a challenge to meet right now, and I think there's an opportunity to just equip a set of students with the hard questions that they can bring to their workforces. And our work is showing that boards are demanding this too. They may not always know what questions to ask, but if we can train boards, train senior execs, and then build a set of analyst capabilities, then you begin to have, I think, a bit more buy-in and pushback. We can't just wait for regulation to hold everyone to account, because it's just not going to get there quickly enough.
So it's a great opportunity for a business faculty, of course, but Rosemary, I'm wondering if you can speak to the legal context in Australia in terms of sort of regulators or any court cases.
Yeah, so ASIC has released guidance just recently. It's a good read. If you haven't read it, it's a pretty good read, actually, particularly the boxes that give examples of what's not acceptable behaviour, most of which you'll look at and say, I read that in an annual report yesterday and that one in a report last week. But, it's been the law of this country that you're not permitted to misrepresent, make misleading statements or misrepresent expectations of future performance. It codified since 1974, and it was common law before that. So this isn't new, but it's kind of symptomatic that we've got to a point where we'd gotten used to selectively talking about alignment or only talking about social and environmental aspects when there was something positive to say in the context of corporate philanthropy or other things. And so this is going to be a change, and we will see the bell curve of human behaviour, but the regulators are definitely coming into the space, and it's also getting competitive. The biggest expose on how MSCI determines its ESG ratings was done by Bloomberg just before last Christmas, and it's well worth a read. So I think we'll see a lot of competitive pressure in the market as well, starting to make it less acceptable. So I think we won't see, a complete absence of companies giving it a try, but it will become increasingly unacceptable to do so. The regulators will become increasingly active, including, as Karim said, looking for examples in the space. And we're seeing a range of things, as you said, Ben, start to play out in the courts as well.
Yeah, thank you.
And I'm quite encouraged. The students that we see every year are much more informed, engaged, and skeptical. And so when they come in, they want those examples. We pull examples from annual reports regularly and ask them, do you believe these claims? What would it take to believe them? And then what's the gap between what's reported and what you would need to get? And I think there is a pathway to actually bridging that, but they're much more informed and skeptical, which I think is a good thing.
Yeah, wonderful. So Professor Rosemary Addis and Karim Harji, thank you very much. Now, before you do applaud them, we do have some gifts over here that will come over. So thank you very much for your insights. It's as you could see, the length of their bios was well worthwhile. So do you want to come around? So please, everybody, put your hands together and thank our guests.
Thank you, Ben, too. Thank you very much.
Oh, thank you.
And thanks to Ben for moderating, and to the advancement team, because I do have to say, this was not on the calendar, and the response to the last conversation was such that Tessa and Amber and Matt and the team have gone over and above to say, we'll do this because it's the conversation our community wants to have. So thank you for that.
Thank you, Rosemary.